Good morning. This is Tracy Prachu with the RCAW, and we're so glad you could be with us today. I have Alex Carrick, who's the Chief Economist for ConstructConnect, and he's got a great presentation for us this morning. So I'd ask you to keep your questions to the end. You can put them in the question box, type them in, and when we get to the end, then I'll come back on and moderate some questions. And we want to thank Alex so much for being here today, and I will turn it over to him.
Well, thank you very much, Tracy. I seem to be having just a little bit of trouble with these slides. So if you can just bear with me, I'm trying to reduce them so that I can, so that they will fit in the screen so you can see them. Okay, let's start off with, I have a number of slides. I'm going to just try and touch on the real highlights of these. You sort of begin when you're talking about the economy, of course, with GDP. And this shows GDP growth from the year 2000. And as you can see, a big deal is being made about trying to reach 3% growth. And you can see by the numbers, because there's a line there that indicates 3% growth. It's not easy reaching 3% growth. And in fact, it has not happened since way back in 2005. A couple of 2.9% growth figures, but not 3%. And this year, on account of the containment and staying indoors and all of that, the annual figure is likely to be quite negative, something like maybe minus 5%. And frankly, if it's minus 5%, if it's minus 5% or less, that'll be outstanding. The second quarter change is probably going to be something like minus 30%, but that's a quarter-to-quarter change and an annualized figure. So given recovery in the second half, the annual figure more likely to be something like minus 5%. The other thing to really pick off this chart is that consumer spending is now about 70% of GDP. Of course, the most dramatic thing that's happened in the pandemic has been the contraction in the number of jobs in the economy. So if you look at total employment, which is the big graph, you can see that in March and April, jobs fell back to their level in the global financial crisis, and they've recovered somewhat since then. Construction jobs did not pull back to anything like the same extent, and they've recovered a bit. I'll have more to say on this in just a second. Looking at manufacturing jobs, again, the big graph is for total jobs. Manufacturing contracted back to about where it was in the Great Recession, and they've recovered somewhat. So really, the economy isn't going to be in good shape again until jobs have been recovered. And this table keeps track of the clawback of jobs. So on the left-hand side, we have the big drop in employment in March and April, and you can see that the total number of jobs fell by 20.5 million, and in construction, they fell by about 1 million jobs. In May and June, there has been a pickup in total jobs of about 6 million, and in construction jobs of about 500,000. So while total jobs in April were down by 20.5 million, they're now down by 14.6 million. And the decline in April was minus 13.5%, and the decline now is about minus 10%. So if you do all the math, you go to the far right-hand column, and you can see that the clawback in total jobs has been about 29%. And then you can see the clawback in all the other categories, all the other industrial categories. And the clawback in construction is about 52%. So construction has recovered about 52% of the jobs that it lost in March and April. And that's the best in all of these industrial sectors. So really construction has been affected the least because construction carried on, and a lot of construction work was considered to be essential. And it was really halted in only a very few number of places, Pennsylvania being one. So construction didn't do too badly in what is being termed already a recession. And financial activities, it was the other one that did pretty good on the jobs front. So remember I said that consumer spending is 70% of GDP. Well, retail sales are about half of consumer spending, and retail sales have bounced back nicely. In June, they were back up to around $480 billion, back kind of in line with that trend line. What that kind of overlooks, though, is that $140 billion in retail sales were lost in that very big downturn there, in that big dip in March and April and in June. Nevertheless, total retail sales in the latest month in June were up by 5% year over year, which is really what you're hoping for. And you can see that non-store retail sales were up by 24% year over year. And I mean, that's just really amazing. But of course, you in Seattle, in Washington, can really appreciate that with Amazon headquartered in your city. So that's positive news for you. And in fact, there are few retailers who have really been hiring of late, one of them being Walmart and the other being Amazon. So some of the other percentage changes here that are interesting. Food and beverage stores, they're up 12% year over year. A couple of months ago, the figure was even higher, but that was because people were stockpiling and hoarding and so on. And there might have even, believe it or not, there might have even been some price gouging that was happening as well. And then at the very bottom of the chart, we can see where food services and drinking places total sales in that category minus 26%. And we all know that that's where the job losses have been most severe. And it's been among young people working in bars and restaurants and hotels and motels. And then I just always like showing this graph because it's just so out of the ordinary. I mean, I don't know how they're going to write economics textbooks going forward. They're going to have to revise the courses somewhat because this is so out of the ordinary. You just don't get graphs like this. You didn't used to get graphs like this, where the change, where the dollar volume of food services and drinking place sales just drop like a rock, and then non-store retail sales have just taken off. And this is sort of the same graph, and it just shows the total retail on a year-over-year basis. Sales are back to what you're hoping for, the 5% change. But food services and drinking place sales are still down by 26%. Now I'm going to come to something, and you might wonder why I'm even talking about this, but this is foreign trade. And you know, the last couple of years, there's been tariff wars with China and Europe and Canada and Mexico and so on. But the bottom line is that the US trade deficit is still very steep. It's like minus $900 billion in terms of goods. It's not quite as bad as it was, but it's still down very dramatically. And from your perspective, the thing to know is that Washington State is the fourth largest exporter among all US states. It's fourth behind California and Texas and New York. And of course, the population of Washington is nothing like as large as for those other 3 states. And the other thing to know is that exports by Washington are about 4% of the US total. And then if you look at trade as a percentage of the state's GDP, it's 15%. Now that's a sizable chunk. And the major export product from Washington is airplanes. After airplanes, they're almost all agricultural products. It's things like soya beans and wheat and apples and so on. But nearly half of the total export figure is airplanes. And so the drying up of trade, and nobody's buying airplanes right now because people aren't traveling. So everybody knows that Boeing was very big in Washington until it moved its headquarters to Chicago, but it's still very big in terms of manufacturing. And I wouldn't anticipate that Washington's going to pull out of this economic malaise as quick as maybe some people are hoping. And one of the factors will be the decline in airplane exports. I hope all those numbers sort of tied that argument together. And if you look at the sources of the US trade deficit, China used to be about 45%, and that's been reduced to about 37%. That China accounts for 37% of the US trade deficit. So that has been reduced by the negotiations with China and the back and forth bickering over tariffs and so on. But at the same time, there are a lot more imports coming in from other places. And strangely enough, Ireland and Switzerland are 2 of those locations. And with Switzerland, it's gold and it's medicines and pharmaceuticals and so on. And with Ireland, it's also pharmaceuticals. And if you're talking trade, just so you know, I mean, this is a chart that shows the world price of oil, and it got up to $145 per barrel way back in July of 2008, and then actually went negative for a while in April to minus $40, but it's back up around $40 per barrel. I'm not going to dwell on that a whole lot because that doesn't have that much relevance for you. I wouldn't think, well, it might though. I mean, it might in the sense of asphalt because of the roofing side, and asphalt prices came down very dramatically, but they're headed back up again. It's one of the few building materials that over the last little while the price has been increasing dramatically again. Okay, in terms of interest rates, well, we know that the central bank, the Federal Reserve, has committed to keeping interest rates near zero for a couple of years. It's committed to doing that for a couple of years at least. And that's all very well, because that's a stated objective. But there's cross currents, like a whole theme, I guess, of my presentation is that there's cross currents at work here. And at some point, because governments are taking on so much debt, the rating agencies are going to start to be involved. The rating agencies did not distinguish themselves in the Great Recession or the global financial crisis. They let a lot of things slide. And so they have to redeem themselves. And at some point, they're going to be looking at the large debt and deficits. And when that happens, when you got a credit rating agency saying that government debt may have to be downgraded, then that means interest rates have to rise. So it's not as clear as maybe everybody's thinking that interest rates are going to stay down. The argument was, isn't it lucky that this is happening when interest rates are so low? Well, yes, it is, as long as they stay low, that the amount of debt that can be taken on can be serviced right now because interest rates are so low. Well, we'll see. So looking at the stock market activity, and again, I would think that this would be something that should be very interested in. in that it's just been amazing how well NASDAQ has done. And NASDAQ, of course, is the home of the high-tech sector stocks. Facebook and Amazon and Google and Microsoft and Apple. And well, not they're not all on NASDAQ, but just the same. Most of the high-tech stocks are on NASDAQ. And NASDAQ is actually up 600% versus its last trough level in February of 2009. 600%. Now, how can the stock markets be doing so great when there's a recession and so many people have been laid off? Well, that's a good question, and it's a bit of a mystery. And it's partly because money supply is being increased. So where is the money going to be parked? Well, it's going to be parked in a number of asset classes, one of them being stocks, another being property, and then commodities. You can invest in commodities, you can invest in fine art or collectibles, and so on. So there's a limited number of places where the money can go. And even entering this period, this COVID-19 induced period of softness, a lot of equity firms, private equity firms and hedge funds had money, had a lot of cash and so on. So that's helping to support stock prices. At the same time, we're heading into a quarter where a lot of the earnings reports are likely to be quite ugly. So that the upward trend in stock prices, and here's another thing to know, that investment houses, they at a maximum, they'll hold like 5% of their total holdings will be one company. And a lot of these investment houses, they have really loaded up on the high tech, on the really big high tech names. And they're at that 5% level. And there may not be a lot of room to move beyond that now. So I wouldn't necessarily think that the stock markets are going to be as bullish as they have been. And anyway. So what about this post-pandemic world we're heading into? And this is where we start to get into the construction categories as well. Well, I say that there's three forces that are going to really shape the post-pandemic world. And the first of these are attempts to reduce congestion and unwanted physical contact. And these are all pretty obvious. We know this. We've all been living with these over the past 5 or 6 months, 5 months, I guess, 4 months, 4 and 5 months. And then there's shifting trends and personal preferences or propensities. And that's whether you want to continue to live where there's a lot of congestion, or whether you want to continue to work in high-rise buildings because you got to take the elevator and you got to mix with people and so on. And then there's the mobility question. And mobility is likely to both increase because it's being discovered that people can really work from anywhere, which interestingly, that's an interesting development for HR departments with companies, because they used to think that they had to hire people who could come into work, even if they had considerable commutes, but that's kind of being proven wrong now, because you can actually hire somebody, the right person, qualified person, from almost anywhere. You can hire somebody on the East Coast to work with a company that's headquartered on the West Coast and so on. So mobility may well increase because of people moving out of urban cores, but then once they've relocated, they don't have to move to where the job is. They don't have to commute the same as they have in the past. So mobility works both ways. So there's three words here: congestion, preferences, and mobility. And those three words influence almost every category of construction. And then actually you can add a couple of other factors to list of forces too. And I would say that those other ones are demographics and population change. And I'll talk about that as we go through this a bit further. And then a fifth one would be deficits and debt and interest rates. Those things will be shaping the post-pandemic world as well. So in terms of housing starts, total US housing starts, because you see, housing starts, a strong recovery in residential is something that a lot of analysts and a lot of people are counting on to restore the economy. And it looks like housing will be stronger than perhaps it has been in other cyclical recoveries. But I'm not as sure that housing starts will end up being the answer to all the ills that are out there. And I'll go into that a bit. And I know that people are saying there's a big pent-up demand for housing. Well, let's just look at some of the numbers. These are the latest figures on housing starts in the United States. And you can see that in December of last year and January and February of this year, housing starts finally recovered to that magic figure of about 1.6 million units, seasonally adjusted and annualized per month. But then with the onset of the pandemic and sheltering at home and so on, the figure dropped dramatically. But in terms of the long-term pattern of housing starts, this shows the equilibrium level, what a lot of people think is the equilibrium level. And remember, it was only reached in 3 months, December, January, and February, December of last year and January and February of this year. That's the only time that 1.6 million has been reached in a decade. So if you actually calculate housing starts, annual housing starts, since the year 2000, going way back, the figure is 1.25 million units. And when you draw that line through all these monthly numbers, that's really the more reasonable number. And in fact, that's kind of where the total was for about 4 years in a row there. It was right around that 1.3 million unit level. Now, the arguments in favor of stronger housing starts are about the pent-up demand, because even at 1.25 million, there's a gap there. There's a long period of gap, and maybe there is this pent-up demand. And then there's the other arguments that millennials in intention surveys say that they want to move from downtown to the suburbs so that they can have the same kind of lifestyle that their parents and their grandparents had. And they were saying this before the pandemic, even before all the thoughts of congestion and wanting to get out of high-rise units and so on. So that's another force that would indicate stronger housing starts. But on the other side of the equation, and interest rates are so low. So let's throw that into the equation. I mean, the 30-year interest rate is at a record low. But then let's consider some of the other factors, because I always start with population growth. Population growth in the United States on the last annual count was 0.5%, which was very low, historically very low. And then even that had an element of immigration in it. And of course, there's no immigration going on now, not with travel restrictions everywhere. And then there's going to be units that are going to be thrown onto the marketplace from due to extraordinary circumstances. Like the money is running out to help individuals who have been laid off and so on. There's an extraordinary number of people who are out of work, and the $600 extra per week for that, it's likely to be reduced maybe to the $200 level that the Republicans are pushing for, but it's almost certainly going to be reduced, and so there's likely to be mortgage foreclosures and evictions. And then there's other factors as well, such as Airbnb units that were second properties that people bought. And since people aren't traveling, there isn't the same demand from that model that there used to be. And those are properties that'll open up as well. So I'd be a little wary thinking that the economy is going to be saved by housing starts. I don't doubt that housing's going to return somewhat, but I'm not sure that it's going to be a big boom in housing starts. And this chart just shows the difference between single-family housing and multifamily housing starts. And you can see that before the last recession, single-family really took off. But of course, that was caused partly by the thing that caused the huge recession, and that was those variable rate mortgages that were given to people who probably shouldn't have been getting them. And but after 2010, after the recession, single family has recovered, but to nothing like the level that it was before the Great Recession. Multifamily came back very strongly, though. You can see that multifamily starts actually returned above their pre-last recession level. Okay, just looking at some of the regional numbers here, because the first months of the year were so strong, the West still has a 6.3% year-over-year increase in total unit starts, and the West is accounting for about a quarter of total starts in the country. And that's where it's been for quite some time. The South accounts for about half of construction starts. And I'll come to Seattle numbers in just a second. Before we leave these general charts, I'll just show you the building permit figures. The building permit number was it was stuck around 1.3 million units for a number of years there. So that's kind of like that long-term average for housing starts, 1.25 million. And then building permits surged upwards, but then they fell back dramatically, and they're heading back towards that 1.3 million figure. This chart here, this one's really quite fascinating. This is the permits, because everybody uses permits as a proxy for housing starts. This is permits in Seattle, Tacoma, Bellevue, MSA. And the most interesting graph in this quartet, I guess, is the one on the bottom right. And that shows how over time, multi-unit starts as a percentage of total starts have caught up with singles and then surpassed them for about the past 8 or 9 years. And that's occurred in only a certain number of cities, because if you recall a couple of slides ago, I showed you that single family starts were still a lot higher than multifamily starts in the US as a whole. So the cities besides Seattle, where multis are clearly the bigger part of total starts than singles, the others are Boston, New York, Miami, all on the East Coast. And then on the West Coast, it's the cities in California. It's San Diego, San Francisco, and Los Angeles. So just so you know, Washington State, statewide, singles this year, through the first half of this year, are down by 6%. Multis are down by 13%, and the total's down by 9%. In Seattle, singles, these are in units, single family starts, first half this year compared with first half last year. Seattle minus 7%, multis minus 16%, and total minus 13%. And Spokane, which is about 10% of the total for the state, Seattle's about half of the total for the state. but Spokane's about 10% of the total. So Spokane singles minus 1%, but multi is up 62%, but that's off a low base. And then the total for Spokane is up by 27%. Oh, also, I should also mention, just in terms of Seattle's job market, employment in the city is down 12% year over year. And that's kind of maybe a little below the midpoint among major cities in America. The unemployment rate is 15%. That's getting to be down towards the bottom of all the cities, all the 51 cities in the US with populations of 1 million or more. But there are cities that have unemployment rates over 20%. Orlando, Detroit, and Las Vegas all have unemployment rates over 20%. So let's look at the types of structure here. And then I've kind of talked about some of these anyway. So single family, I talked about how mobility and anti-congestion and millennials might account for an uptick in single family starts, and trying to avoid congestion and so on may take away from multifamily starts. The interesting thing, I think, in terms of these forecasts is that by the end of the forecast period, we are talking about single family starts being higher than they were in 2019. So they will be at a new peak level. But for multifamily, our latest projections, which we do jointly with Oxford Economics, the big macroeconomic forecasting agency, we have multi-unit starts that are still below the peak that they achieved in 2017. Hotel and motel starts nationwide, if travel's way down, there isn't going to be a lot of business at hotels and motels. Tourism travel and business travel. At one point, occupancies in hotels back in April was something like 10%. Now it's gone back up. It's around the 30 to 40% range, but that's still nothing like the 65% range that indicated a healthy market. And you can also see from this graph that the volume of starts in hotel and motel category was heading down prior to the pandemic, because this is a sector that's very cyclical. If one company decides that it's going to fix up its units or add units or spend money to spruce up accommodations, they all feel like they've got to jump on the bandwagon. So there's no other category of construction that has quite the same bandwagon effect as hotel and motel work. Private office buildings. Well, this is the really most interesting category of all, because what's going to happen? Are people going to go back to work in office buildings? Do employers want people to go back to work in office buildings? There's an interesting story out of Texas. Phillips Petroleum has ordered its employees to go back to work, partly, and they've been open about this, partly because they want them to do the commute, because when you do the commute, you're consuming gasoline. And so how can they expect everybody else to consume gasoline if they don't have their people coming into work? So that's not necessarily the most noble of objectives, but that's the reality. But a lot of companies have said that they are surprised at how well things have worked out with people working from home. A lot of people who are working from home want to continue to work from home. Some problems are starting to be uncovered. There are employees who are claiming that they can't get projects done on time because they're not able to collaborate one-on-one like they used to be able to, and some companies are finding it harder to train staff and train new staff in particular when they work remotely. Nevertheless, it does seem likely that there's going to be a shift towards more people working from home, and if companies do go back to having people come into work, that they will be staggering schedules and that sort of thing. So if you're a developer, you got to be a little bit nervous about the demand that's going to be out there longer term by owners, and whether they're really going to be willing to spend the money on the big leases that they've got. Okay, retail, well, this is the one that's been talked about for so long, where bricks and mortar locations are closing up, and it's still the case. And it's not just the problem that the big name retailers are shutting outlets, it's also the overhang. And whenever I talk about this category, it's the word overhang that really seems to be important, because it's not just will you build new, but the empty space has to be taken up first. And so empty retail space, it's being filled by all kinds of things. It's by gyms, by car dealerships, by medical clinics. Even now, there's talk about empty retail space that's being converted into residential space. And then the inverse of retail construction is warehouses, because so much is going to the internet, so much of retail is going to the internet, that you need large fulfillment and distribution centers. And of course, that's where a company like Amazon comes in. Nothing says internet shopping quite like Amazon. And the other thing to know about warehouses, though, is that it's not necessarily going to mean a lot in terms of jobs. You see, this is one of those cross currents as well. Warehouses and industrial, nothing says social distancing. Nothing says social distancing like robotics. And warehouses and industrial are going towards robotics. They're embracing that as fully as they can. Hospital construction, well, it had a bit of a resurgence in 2016, and then it quieted down again. That was 2016. There was a Supreme Court ruling that indicated that the Affordable Care Act was legitimate. But then there was a change in the government, and so there's been all the uncertainty about who's going to be funding medical services going forward. And right now, you would think that there would be a big upsurge in hospital construction, but not necessarily, because the kind of activities in hospitals that bring in the dollars, and that's elective surgery, they've been, to a large extent, that kind of work is being put off in order to care for COVID-19 patients. So, but longer term, there's the aging population, and there's certainly going to be, and it's been exposed that there's been shortages of ICU units and so on. So there's going to be spending on hospital construction. And in fact, if you're an association, and I don't suppose this really, I don't know. I would think that there'd be other associations that maybe would be more involved in this, but a lot of associations, I would think, would be looking at future changes to building codes to handle isolation units and that sort of thing more effectively in hospitals and medical facilities, and in prisons too, as far as that goes. Educational construction, well, again, a lot of students have found that they can learn outside of the being on campus. And then also enrollments are down. And part of that is because foreign students aren't feeling as welcome as they were before. So the real momentum behind educational starts, it's hard to foresee that that's going to be any, there's really a great deal of upward momentum there. I talked about industrial to some extent. The Purchasing Managers Index, everybody follows that. Purchasing Managers Index is finally back above 50%, which indicates that manufacturing is expanding. and the economy is expanding. Well, that's all very well, but the capacity utilization in manufacturing is still below 70%. And capacity utilization really has to be up around 80% for owners to start adding additional square footage. Transportation terminals, this was a category that was huge. There were all kinds of projects on the drawing boards prior to what we're going through, prior to this current situation. And certainly Seattle has benefited from this. You have a number of major transit projects that were recently initiated. Again, longer term though, nobody really knows what's going to happen. Are people going to commute like they did in the past? Maybe some of these projects aren't really going to be needed for another couple of years. And that's propensities. That gets back to that word propensities. And then I'm not going to say much about these other categories because they're not really in your wheelhouse. Heavy engineering, that's the big showcase projects like railroad projects and pipelines and so on. And then, okay, so for grand total starts, we have them not really returning to 2019 levels until about 2023. So just a couple more slides here to go, and maybe I'll save this for the questions if you want to get into construction costs. But I would I'll just conclude by saying I don't know that anybody's really talking about V-shaped recoveries anymore, and there are a lot of landmines out there. So there are things that might just pop up out of almost nowhere, and so I think there's still a pretty rough road ahead here for a while. And I have an airplane story. I'm going to conclude with my airplane story in a minute, and I think that kind of encapsulates what I'm talking about. But other landmines include things like the reduced population growth. I mean, a lot of economic growth depends on population increases. And then there's mortgage foreclosures coming up and rent payments that are being missed, both on residential and at the commercial level. And there's the government debt and diminished tax revenue by government. So anyway, let me just tell you my airport story, because I think this kind of encapsulates the problem for the economy. We all know that people just aren't traveling the way that they used to. That the number, and then the TSA readings, they're still way down, but people just aren't going on business trips and tourist trips the way that they did before. And if you haven't got people going through an airport, then you've got hotel and motel occupancies are going to be down. And I talked about that. But then you're also going to have limo rentals that are down, limo and taxi rentals that are down, and car rentals that are down. And in fact, Hertz has gone into bankruptcy protection largely on account of that. And if you don't have car rentals, then you don't have the same fleet purchases from the automakers. So that's one of the ripple effects. And then also airports, they used to be really the last bastion of retail. And if you don't have people, bricks and mortar retail, the last bastion of bricks and mortar retail. And if you don't have people in airports the same way, well, those retailers, they suffer. I've for a while, I've been buying a lot of my clothes simply because it's most convenient at Brooks Brothers in airports, simply as I travel. And of course, Brooks Brothers has gone into bankruptcy protection. And if you don't have people traveling, then the need for Airbnb facilities isn't the same, and that affects residential construction. So anyway, that's just sort of a way of showing that the implications ripple out from some of these sectors. I talked about whole industries that may take years to fully recover. And Warren Buffett sold all his shares in the major airlines. So that kind of gives you an idea of the thinking of the people out there who really know what they're doing. Anyway, so that's it. And I will try to come on camera for questions anybody might have. Don't know whether I can do this or not, but Tracy?
Hey, Alex, thank you so much. That was very interesting. The first question I have is, what do you think will be the immediate economic impact of the end of the $600 weekly unemployment benefit?
Well, yeah, it's like, I understand the logic of doing it because governments are going to be saddled with an awful lot of debt, and this is the concern. And to some degree, um, the countries that can get out of this with as low debt as possible are probably going to be in much better shape than other countries. But the problem is that other countries are not having the COVID problems that the United States is having. So other countries are able to open up and so on. So it's all tied together. And initially, the government bailout money was spent properly, I think. It was in income supplement plans, and then it spread out to small business, helping small businesses, and then certain segments of the economy and certain industries and so on. But okay, let's look at it in terms of the unemployment situation, because everybody knows that the initial jobless claims number has been horrendous. Since the end of March, the cumulative figure for initial jobless claims has been 50 million people. Now, quite a number of them were taken back, but then they're being let off again because states are having to retreat on some of their reopenings. But what does it mean when you've got 50 million people who have lost their jobs, who are on greatly reduced hours, or have been furloughed? Well, the size of the US labor force is 160 million. So it means 1 in 3 people has been through the trauma of having their job either disappear or really downsized. And they need that money. They need that financial help. So I think it's going to be one of those landmines. This is where you worry about in the fall. There's a whole bunch of things that are coming up in the fall, and one of them is whether the children go back to school. If the contagion was under control, the children could go back to school and people could go back to work easier. I mean, that's really what this is about. Children going back to school is freeing up their parents to go to work. But if you can't do that, if they can't go to work and they're not getting the assistance that they were, then these things all just add to each other. And I don't think that it's a pretty picture. And the retail sales that did so well, a lot of the support for those retail sales are back to being 5% year over year, but a lot of the support for those strong retail sales has come from those government income supplement programs. And if they're not there, then you're taking the props out from that retail that has helped to prop up the economy. So I think it's I think it's, you got to think long and hard about what you do in terms of helping individuals, because this isn't like other recessions. And I'm sorry I'm going on a long time about this one question, but the whole thing is that this is not like other recessions. People are always asking me, well, shouldn't there be a really massive infrastructure program? Infrastructure programs have worked with other recessions, but I'm not sure that that's the way to go with this recession, because that just adds to debt. I really think that the money needs to be spent helping people to get through this. I mean, when it comes to infrastructure, you don't even really know anymore what that infrastructure money should be spent on because of the societal changes that may well be underway. Do people need the same kind of infrastructure projects that they've had in the past? Do they need the roads and the bridges and the airports and so on? Well, it hasn't been established that people are going to travel and commute like they have before. China is embarking on a big infrastructure program, but everything in China is owned by the government, and they have decided that this time around they're not spending it in those traditional areas. They're going to spend the money on call centers and on biotechnology labs and things that promote and data centers, not call centers so much, but data centers, and 5G networks and so on. So it's a matter of where the money goes, and there's going to be a lot of debate about it. But my own inclination is that people are going to continue to need support for some time. Okay, Stacy. Stacy?
Do we have any other questions? Doesn't look like it. I want to mention to everyone that all of the slides you can download under the handouts, so you have the slides. And then we will also have this webinar on our website, and you'll be able to rewatch it at any time as well. And if there's no more questions, we'd like to thank Alex for this great presentation. And thank you all for attending.
My pleasure. My pleasure.
Thank you all. Take care. Bye.
So Tracy, are you there?
I'm still here.
Okay. Is everybody else off?
No, not quite yet. I need to stop the video.